This is episode 124 of the XY podcast with Scott Farmer. If you're part of the XY Facebook group, you'd know we really try and focus on the things within the industry and our businesses we can control and keep discussions as positive and constructive as we can. In saying this though, we of course understand there's a ton of uncertainty within financial services at the moment. However, even in light of this, Scott Farmer, the founder of Bravium, really believes this is a golden opportunity for advisors to reevaluate their business models, think about how they can add and articulate value to their clients, and continue to evolve. He doesn't for 1 minute think it will be easy, but he's confident it will be so worth it if advisors are to continue making a meaningful difference to clients' lives and build profitable businesses. This episode is Scott lifting the lid on his business processes and values and showing us what's inside. Scott explains how he made the switch to a fee-for-service model, what he thinks the first step is to letting go of insurance comms, his initial client engagement steps, and why he went out and built his own cashflow fintech solution. Before we kick things off with Scott, and for those who missed it on the digital grapevine, XY on Tour is now live and tickets are available for you to get your hands on. 25 speakers across 6 locations with hundreds of advisors and one elusive yellow combi. And for the first time ever, we're heading to the Gold Coast, Newcastle and Canberra. Head to the show notes of this episode where you can find the link to grab your tickets now.
Hub24 is an ASX-listed company with over $10 billion funds under management and one of the fastest-growing platforms in the market. Neither a bank nor part of a bank, Hub24 focuses entirely on connecting advisors to a broad range of investment solutions for their clients. Discover why other advisors think Hub24 are the best in the market and access the benefits of choice and efficiency for you and your clients with their market-leading managed portfolio solution. To find out more, visit hub24.com.au.
Well, we're here today with Scott Farmer from Bravium. Is that pronouncing it right?
I'm not sure. Bravium is how we say it anyway.
Okay. Well, you guys are from Canberra, so say things differently. So, Scott, it's been a big week. It's Royal Commission's come out, and you're like down in Canberra. Do you feel like you're closer to the action down there, or?
Not really. No, I don't think it feels like that. But yeah, huge week though. Yeah, absolutely. So a bit more clarity, I guess, on what it all means.
Do you feel that clarity in terms of, I guess, what they've said and what their intent is from the Royal Commission? Do you feel that, can you see the changes that are going to happen? What's your confidence level on what's going to be executed? And
yeah, it's interesting, I think. My view's always been that government wouldn't lead change in our industry, and I think probably the Royal Commission was the best shot that they'll ever have at actually trying to force through some kind of permanent cultural change. But in all honesty, I think what will lead the industry to make significant change is probably the clients. And if you look at history, they've probably led most of the changes to date anyway. And I think what will happen is we'll have successful businesses who are trying new business models, and I think more advisors will see those models being successful and will look to replicate something similar or have their own ideas. But I think the idea of kind of replicating what's happened over the past 20 or 30 years is dead. Nobody wants to do what we did 20 years ago.
Totally. Well, the government doesn't, definitely.
No.
But also, the key point, the consumers. Yeah. I think that whole product market or service market fit concept is something that's really applicable. Because even if you took out the Royal Commission, a lot of these changes that people will be doing in reaction to the Royal Commission are actually things that need to happen to become better businesses anyway.
Yeah.
So, the way people want to consume advice and what sort of services they want, what sort of value they want to get out of it.
Yeah.
So, I guess, I've had a couple of, especially advisors where they've been doing broking and advice, and those guys, they're an advisor, so they're already feeling pretty vulnerable. But then they're this mortgage broker that's just getting kicked in the balls sort of thing as well.
Almost.
And I don't know, it's sort of, I've been talking about the concept of advisors have expanded their services offering to try and appeal to obviously seeing value in different areas like cash flow and other areas, but it's also an opportunity for mortgage brokers to sort of add value in. I was talking to them about how they could do preparation for lending. Like, how do you, that whole process that you go through, working out, like getting ready for the lender, that could be a whole service that could be delivered that people would get heaps of value out, because the way that it often, if you don't have a broker, it can be often, I don't know, not necessarily as smooth as you'd like it to be. What do you think about the broking side of things?
Well, my understanding is that the government has effectively deferred the broking commission aspect for 3 years. So I guess if I was a broker, I'd be hoping that the Liberals get back into government, because I suspect that's code for let's leave it until everyone's forgotten about the Royal Commission and we'll sweep it under the carpet. Because I think there's some significant problems with just unwinding the broking industry, and I think there's some challenges for them. If commissions and trails are just completely abolished. So perhaps there's more to worry about if Labor get in, and perhaps they'll be more, militaristic in the way that they implement some of that stuff. But I do think that these are the opportunities to relook at your business model and think about how can we add value and what can we do better and what do we do well and how do we leverage off that. Absolutely. So, and it's probably something we all need to do all the time. A small business, we need to continually evolve. So,
have you made, like, after the release, is there any key changes to your strategy going forward this year in your financial advice business that have changed? Or?
Not in a significant way. If there's anything for us, it's probably around marketing, I think. We made a lot of changes back in about 2009 to the business, and at that point we really wanted to move away from all product-based fees at that time. And so a lot of the stuff that's happened, like fee disclosure statements, etc., over recent years, we've kind of already been in front of that, because we use an annual engagement with all the clients. All our revenue comes from the client. We re-quote every year, and in effect, what we do is we reconfirm with the client every 12 months how we're going to add value for you, and we want to add significant value every year. And so, when you're having those discussions, what it evolves is I guess your thinking starts to be around how do we add more value? What do we do that we could do better, or what don't we do that we should be doing or could be doing? Whether that's in-house, and do we need to get a broader skill set or an improved skill set, or are there relationships we need outside the business that we can bring in, so we've got the expertise we need to come up with solutions. But I think that's probably, that was really the first step for us in moving away from product.
So you've been doing this annual renewal. How long have you been doing that for? About
9 years.
Okay.
Long time. Yeah. So well before, it probably became the fee for service catchphrase came in, I guess.
Yeah. Well, there's plenty of good reasons to have you on the podcast, but I think in terms of timing, there's a lot of advisors out there where that is a really scary proposition. And I'd love to, if you don't mind sharing, sort of delving into a bit of how you've done it, what that looks like, so really something that advisors could take away going, okay, Scott's been doing this, I'm going to have a crack at that.
Yeah, I think that, and I think I've been in that position where I could imagine myself scared of being where I am today, as far as the business model goes. And in part, I think, that's not enough confidence about there is a lot of value in what we actually do. And, I've been in the industry a long time, 20 years, I think it might be this year, actually. I know I look young.
Well, anyone watching YouTube, you can see, but guys that are on the audio, you wouldn't think he's been around that
Picture
long. That's
it's I think a matter of understanding and being able to articulate well what is the value that we add, and if you can get better at that, then all of a sudden charging for your services becomes a lot easier. We've talked to advisors occasionally about, because it's one of those topics, well, how much do you charge? And it is how much is how long is a piece of string? But a lot of advisors get scared when you start talking about $10,000, $15,000, $20,000, $30,000 a year for clients. But in our experience, they pay it as long as you can show the value and articulate that well. And a lot of this comes back to actually understanding what are the outcomes that clients really want? And so that conversation's got to be really rich and deep, because ultimately when we're holding these discussions and we're providing a terms of engagement letter to clients, we're really, to begin with, really quoting that information back to them and saying, our understanding is these are the things that are important to you, and there's got to be some detail in that. And then I think the link is, how do you get the advice to marry up to all of that and actually show them how you can help them?
Yeah. So I guess one of the things, I always like to think that if you can get there's a few key processes or ways of doing things from a functional standpoint or a documentation standpoint, that if you get that methodology, then that gets you in that direction. How much is the process that you guys go through versus the conversations you have?
Yeah.
Because obviously the conversations provide the inputs into that framework. How much I love the idea of being able to go, okay, if we give advisors that haven't tried this, we give them the right framework, then they'll start to gravitate into that and have the conversations that feed that. What's your perspective on that? Is it just something that that won't work, or?
So it's a really good question. So the way that I went about it is I fixed my engagement with a client first, because ultimately, if you don't get that right, the clients don't sign up. So it doesn't matter how good your framework is afterwards, becomes irrelevant. And there is a confidence issue there. If you change the way you engage with a client and you change the way you charge them, you've never done it before, the most nervous person in the office will be you. It's not the client. They've got no idea. They don't know you don't do this or haven't done this a million times before. So you're the nervous one. And if you don't sign up that first, one or two or maybe three clients, the tendency is to go, oh God, I'm not doing this well enough. It doesn't work. I'll throw it in the bin and I'll go back to my old ways. And so, you need a bit of confidence, you need a bit of discipline to stick with, it. And pricing is hard for everyone, for you and for the clients, because often they don't really reference. They don't know, is this fee going to be $1,000 or $15,000? They guessing, basically. So we started with fix the engagement, get the conversations better, understand in a lot of detail what they're actually wanting from us. And then we spent a lot of years getting the process better. And I guess in my experience is that's facilitated us being able to increase our fees because we do more now than we did 9 years ago, and we do it a hell of a lot better. And that'll never stop. We still have regular meetings in the office to sit down and go, okay, what doesn't work in this business or in this office today? What are the roadblocks we've got? Why aren't things progressing the way we want them to progress? And then what can we do about it? Is it process driven? Is it a skill issue? What is it and how do we fix it? And you never stop doing that. I
think that confidence aspect that you mentioned is a key part, because you talk to, I went through that journey of changing from, I got taught to insurance advice. That bit was commissions, and that was the framework. And I was like, I want to try this fee. I'm pretty adventurous, so I was like, okay, I'm going to try this fee for service thing. But you're right, that you're the one that's actually got the gap in perception of whatever value's going on in the room.
Yeah. Because
there's plenty of advisors out there, they do things completely different ways. What's consistent is that they believe what they're doing. And the gap that emerges when someone's trying something new is that you've really got to regain that belief in yourself and the belief that you're on the right path, and I guess see those client outcomes. Also, see not necessarily the client outcomes, but the client see the end of that service, and that the clients still they're happy, they've enjoyed the service, and that you then start to feel that you went down the right path. So I think, that's really, and when I think about that, I go, well, for a lot of people, then they're not really willing to do a significant leap. So what are the baby steps to, if you were going to go, okay, there's a practice out there that's got, they do fee for service around insurance. A lot of the fees come out of, fee for service around superannuation, investments, and that part of the advice. They might do some cash flow activity. Part of the fees come out of superannuation. That's another thing to discuss later on. And insurance is commission. They might have started charging maybe an implementation fee or a small fee. For these people to completely let go of insurance commissions, what do you reckon the first step is?
So, I think that it's much harder to go back to your existing clients and try and change the way you've engaged with them. It can certainly be done, but it's a lot harder than dealing with a brand new client that's never met you before and has no idea what you do. So I think step one is to trial something with your new clients, the people that haven't met you before. The other thing that we've done as a business, and not everyone will necessarily agree with this, but we're really strict with it, is we don't do any transactional work at all, and haven't done for years. So if somebody comes into us and says, look, I just want you to tell me an answer to this one question or provide a solution for this one issue, I don't want you to look at anything else, we refer them off because underlying is we want to provide significant value, and I don't think you can if the client puts blinkers on you and says just deal with this one issue for me. And then what happens is you become you put under a lot of pressure on the price because the client wants to drill you down. I want the solution or the answer to this for the cheapest possible price.
Yeah, you put into this commoditized space.
Yeah, they're not looking for a relationship, and so you kind of become the ITP of the financial planning world. And that I guess, there may be firms out there that will make that very successful, but it's not us. And we don't want to have 400 advisors around the country. So we've always stayed well clear of that. And what that's allowed us to do is to think more broadly about, well, these are the outcomes you want. If we want to maximise the probability of you achieving all of this, we have to look at all of this stuff. Because if we leave the superannuation out, or we leave the insurance out, or the estate planning, or the cash flow out, all of a sudden it starts to break down. And our experience with the way that we charge and the way that we engage is as soon as the client starts saying, look, I don't want to do that or this, I just want you to do this bit and this bit, and we've made the mistake of going, okay, well, we'll do this, and it's always ended in disaster because the value proposition breaks down too much, and then the fee looks expensive to the client, and so we haven't done that for many years now.
How long ago, I guess, when did you first start that sort of transition? Like, when did you go, like, what was the start like when you first came into advice? Let's have a look at that.
So when I first came into the advice industry, I was actually working as a lending specialist in the Commonwealth Bank. So I was there at the time when mortgage broking was mobile lenders, as they called them in the bank. It was relatively new. I was there when they bought Colonial First State, so we've just kind of almost come the full circle now with them, exiting Colonial. The bank transformed immensely around those years that I was sort of transitioning into the advice industry. So there were no financial planners when I joined the Commonwealth Bank. This was a new thing. And I remember talking to one of the managers about, look, I want to make this change and get across into the advice side of things. It probably took about a year before, I got across there, and this is in WA. So they sent me over to Sydney, never left the state prior to that. I know I might have been to Queensland, actually, but came to Sydney. It was around the time of the Olympics, actually. So it was all very, my goodness, this big
It's a
city.
bright lights.
Yeah, that's right, yeah.
Were you coming from Perth or a rural area?
No, I was coming from Perth, yeah. Although I was born in a
Mind you, Perth back then probably was a bit more rural.
Yeah, I was still a decent sized city.
It was? Okay.
Yeah. It was still plenty of skyscrapers. So probably a lot bigger than Canberra anyway.
Yeah.
So. But yeah, so it was all, the financial planning industry back then was not long out of door to door, insurance salesman really. So it was in its infancy. I probably spent, 7 or 8 years, I guess, in the Commonwealth Bank, and then into a stockbroking firm, and then a smaller financial planning business in Canberra when I'd moved. And I remember, sitting there one day thinking, and this is talking about what we were talking about before, what value do I add? I literally feel like I'm just, regardless of who the client is, I'm just flogging them a managed fund and maybe some insurance. And it's rinse and repeat day in, day out. And I was really disenfranchised at that point, thinking there's got to be more to the industry than this. To the point where you're almost, embarrassed to talk to somebody at a barbecue about, what do you do? I'm a financial planner. And you're almost scared of the conversation about, well, tell me in detail what you do, because you're kind of thinking, oh, God, I just flog some product. That's how bad it was. It's certainly in my experience anyway. So when I made the decision to get out and start my own business, what I wanted to do was to move away from product, but it took me a few years. At that point in time, I looked around at what everyone else was doing, and probably some of this still goes on today, where you've got different service package offerings for platinum and gold and bronze, or whatever you want to call them. And I remember thinking about it and going, but how would I get a client from the bottom package to the top package? Why would they start paying me more for different,
what's the difference?
For a newsletter, or because that's what it was in those days. And I thought that just doesn't work. It just doesn't make any sense to me. And I ran the numbers and I thought I'll never make any money by adopting a strategy like that. And of course, if you don't make money, you can't grow. And I didn't want to sit in an office by myself for the next 20 years. So it took a few years before I finally kind of started to work out a way to do this. And start to get back to, the value is all in the client conversation, the client's head. We've got to get it out of them, and we've got to have better conversations to do that. So that was kind of the transition, I guess, for me into where we've got the business now. And it's been, the best part of 10 years. And I think we had our training wheels on for probably the first 2 to 3 years.
Do you remember the first time that you had the discussion about fee-for-service insurance?
Well, I've never had one, because I've always been a broader business than that. So I've never just isolated the insurance and dealt with the client from a fee-for-service kind of proposition. When we converted to this style of operation, I guess we're always more holistic than that. So, yeah.
So not taking commission?
For those first 2 years in business, we were using commission. So in that period when we were trying to struggle to work out how to get to where we wanted to get to, we were still using an asset-based fee on the funds side and a commission on the insurance side. I think it was about 2 years, and on that day, I literally drew a line in the sand and have never gone back, not once. And because the business has been around for about 11 and a half years now. A few years ago, we got to the point where we said, right, that's it. We're eliminating all the commission legacy stuff we had in the business, because it wasn't significant. I think it was about 2% of revenue. Okay. So we literally just said, right, that's it. It's all going. So we either converted the clients to our terms of engagement, or we simply we advised the client we couldn't service, and we removed ourselves as the advisor.
Okay.
And we've been very, very strict about never swaying from that.
Very ahead of the Royal Commission on that one.
Yeah. So yes, absolutely. Yep. So we don't have any of those sort of complications, I guess.
It's interesting when you talk about the breadth of services that you didn't feel that it was a big leap, because you had so much value in other areas. So there's probably a bit in that, in terms of, I guess, the scoping of what you do as an advisor. Maybe that's one of the first steps to broaden, so maybe you don't have to jump straight into no comms for insurance. You maybe just start expanding the value proposition. Because I remember when I started with the insurance discussion, fee for service, what I went into first was actually going, these are the two options. Actually, no, sorry. I didn't even go. I went, okay, fuck it, let's go all in. But when I've talked to other advisors, I said, okay, just start having that discussion first about commission and no commission. And just having that discussion allows you to unpack the value chain or what's being delivered there, and you start to, just by going through that process, it's really powerful to that discussion. You start talking to the client, and the discussions with the client, it really puts things on a level of value for the insurance advice. So you really start to, instead of it sort of not swept under the table exactly, but not fully being understood by the client in terms of the significance of this service, like and that they the necessity to value it isn't always put there with commissions.
Yeah, I mean, it's funny, that if I was a risk-only advisor, there is an awful lot of similarity to the discussion now with mortgage brokers, because you're dealing with a single suite of products, and you're dealing with a product suite the client can get without you. So you can go to the bank and get a home loan, or you can go to a mortgage broker. You can go straight to the insurance company and get an insurance product too if you want. And so the value is in the advice that you can provide to the client and just sort through the mess. And of course, clients are busy. And the busier the client, the more they're going to want to pay someone else to deal with all of these issues. So there's a lot of similarity, I think, between the challenges for risk advisors, and they've probably been thinking about it longer than what the mortgage brokers have. But very similar complications, I guess. So it's interesting.
Yeah, and I think and the requirement to put a price on there is one thing. That's a whole process around that in terms of how much do you charge and what do you set there. And even when I went through that process, it was quite significant, because you get to sort of go, okay, well, shit, how much? Like a lot of businesses, and the challenge with a lot of businesses, especially if you're a small business, is really being accountable around how much costs. How much things cost to deliver. Because across the board, advisors are really good at underestimating that.
Absolutely.
They're really good at forgetting about how much time they spend thinking about something, like in the morning that related to this one client. Even underestimating like admin time and things like that. It's
absolutely.
And once you start... it's a scary space, because and you can understand why a lot of people don't go into it, because it's quite depressing once you actually jump back the numbers.
Yeah, you do almost need someone else to push you on price.
You do.
Because most people aren't going to have enough courage to push themselves far enough on from a price perspective. But with the risk advice, one advantage you do have is if you pull the commission out, the premiums drop. That's not the case with a home loan. So you pull the commission out, you don't instantly get this drop in the home loan rate.
Exactly.
So you can represent an insurance recommendation as this is the cost for these benefits and this product, and
you save 25% for the life.
When you save 25 or 30% of those premiums, that equation starts to look very attractive, and then you're simply getting the client to understand that there's significant value in you providing all the advice, because there's a million options and a heap of different type of insurance and all the different variables in setting those policies up. So making that easy for the client.
The significance of the commitment.
Correct. And having you on their side. So, we know some of the banks got into trouble because effectively the advisors who are selling the insurance product were working for the bank, not for the consumer. And so when there's a claims issue, that advisor can't push too hard, because they effectively have to...
too close to...
Correct. So the boss says, that's it, it's done. And the advisor has to go, okay, no problem. For us, if we're not happy, we can continue to push and continue to shout. We fight for the client. So there's a lot of value in that.
On the broking side of things, I was doing broking for a bit, and I'd gone through this insurance fee-for-service process, and I was like, okay, so let's see what we can do around this for mortgages. I can set a fixed fee. Doesn't mean so I'm not fucking around, not getting paid. Like because I used to just sit there when the loan, you wouldn't get the loan done, and arguably you could argue that you're a green mortgage broker. What a rookie! You got to that stage and you didn't get the loan done.
Yeah.
But I was just sitting there going, well, we do all the work. I actually just got so frustrated by the work being so front loaded. I'm like, this is bullshit. Like. I don't want to get paid I don't want to start doing stuff unless I know I'm going to get paid.
Yes, absolutely.
And so really I started exploring that just purely out of that frustration. I'm like, I don't want to operate like this. I want everything I commit to with clients to be...
profitable.
Yeah.
Yeah. I mean, it's interesting because... we're an industry that's always come from this concept of cross-subsidisation.
Swings and roundabouts.
Yeah, we've all experienced the concept of, I'll take this client on because in 10 years' time they might be a good client. I won't make any money on them for 10 years. And the problem with that is that some percentage of your whole client book is losing money. And whilst, yes, some of those might become good clients later on, you're replacing them with clients that still are losing money. And so, that in my view is not a great way to run a business. It should be profitable and valuable for everyone. You as a business, yes, you might do pro bono work, but that should be very clear, and you should make some decision about this is the level of pro bono work we'll do, and you think differently about what's the nature of that work and how do you want to engage and who do you want to engage with. But if it's not pro bono work, it should be profitable work.
Totally.
And then you need to show the value to that client.
On that mortgage side of things, I was like, I actually came up against the wall because I was like, because as you said before, you can't strip out the structure of the broking of lending.
Yep.
It's not structurally set up to be able to dial down. So I'm sitting there going, how do I do this? I was asking heaps of people, and then I'm getting messages that, gee, you got to be careful because you get they actually stomp on you from a aggregator, the lenders, because they all want to keep that structure. So it's
before your time.
Well, obviously different reasons for going down that path. It was more self-centered, but because I was just frustrated about, I just wanted to charge a fee and get paid.
For the work you do. Crazy idea.
But I guess that's one way to go about it in terms of, and that's what I suppose I'd encourage advisors to just think about. Just get really selfish about. I think what holds a lot of advisors get torn between the ideological side of things in terms of I won't be able to service clients, and that's what you hear from people, and it's true, you can't, and it's heartbreaking for a lot of people, and it's really frustrating, and a lot of people get into advice because they want to do that. So that's I see that as one of the biggest impediments of people actually not wanting to being less, ideological about what an advisor can do.
It's an oxymoron, isn't it, when we talk about inactive clients? That phrase always gets me, and it's been talked about a lot, in the last 12 or 18 months, but inactive client, that's not a client.
Exactly.
That's just not a client. So, it's interesting.
Well, it's so in terms of, so we talked about the sort of the commission side of things. What about service proposition? So, you've been really specialising in cash flow management, and you've really, my understanding from our previous chats is you've got it as a cornerstone of, I guess, the process, and I'm going to guess that it's actually one of the foundational elements of when you start to work with a client.
Absolutely, yeah, it has been for a while now. I guess we don't really want to give clients fairy tale advice. It's advice that's based on numbers that aren't real, with projections that are out over many years about assumptions that really, are hard to kind of narrow down. And I'd spent some time, delivering advice to clients in previous years, and then looking at kind of the blank look on their face, and you can see that they're thinking, well, we don't have that much money, even though you've confirmed in the meeting prior that this is how much we spend, and you can work it all out pretty easily with how much money should be available. And they go, we've got none of that money. Well, you've got $25,000 a year here you're using for all these different things. We don't have a single cent. And so, without the cash flow piece, all the advice you do, is just not valuable. And so we want to deliver advice that we know can actually be implemented, because we deal with enough variables that we can't control, and that's one that you can. And if you're trying to move your business away from product-based fees and product-based advice, it's a really good starting point. And we had a client only a few weeks ago, a young professional, and we tend to do a lot of work with that sort of demographic. And he said to us, after we'd presented our terms of engagement letter, he said, this cash flow stuff is the most important thing I think that you guys can help us with. So all the other stuff we talked about, the cash flow was the one thing he highlighted to us, which is almost the opposite of the old business model where, some advisors that say, we only work with engineers who earn $300,000 a year and have $2 million to invest. It's the opposite, because these young professionals, they don't really have any money to invest. But what they are conscious of and they tend to be quite aspirational, is I earn all this money, but I don't know where it all goes. And they're smart enough to realise that if they keep repeating what they've been doing, in 10 years' time, they won't be anywhere, and they don't want to be in that position. So that cash flow piece is really critical. And it fits, from our experience, into most of the client demographics, but perhaps in slightly different ways. You know, the way we do cash flow with a retiree is very different and I think less valuable, but still valuable than what it might be for, say, a young professional. And as long as you understand that and you price that accordingly, you can still do this work for most clients.
How do the engagement steps work with that? So for an advisor out there to understand how that process works, initial engagement with the client, how does it look?
Yeah, we so when we talk to clients about cash flow in our terms of engagement letter, we actually kind of kick it off with a pretty upfront statement, pretty confronting statement actually. And we'll occasionally get a smile out of the clients as we go through it. But we basically say to nearly all of them, because it's the truth for basically all of them, we feel there's a lack of discipline in regard to your cash flow. And so that's a pretty, you're trying to get this client on board. That's not telling them something warm and fuzzy. That's telling them something a bit prickly. But it's the honest truth. And, we've actually had clients sign up off that statement alone, because at the end of the engagement, they go, you're exactly right. That's exactly one of the problems that we have. So they realise it, and you shouldn't be scared to talk about it. And in fact, that's probably one of the areas that we have looked to ensure we always do, is to give the clients the advice, not they necessarily want to hear, but the advice they need to hear. And so again, that's, that can be...
Well, at that stage, it's just general advice.
No. So not at that point, but when we get to the advice component though. Yep. So, we've all had clients where that, in fact, we had one the other day and we lost this client. But they're 12 months from retirement. They're taking 1/3 of their total retirement nest egg, and they've bought an off the plan apartment for the daughter to live in. And we looked at that and thought, oh my God, this is a terrible, terrible idea for a bunch of different reasons. And so we wanted to raise this with a client, and we wouldn't normally do that at that point, but we got a conversation going in a bit more detail about what was the motivation behind this purchase, because they hadn't exchanged contract yet and they were about to do that. So we wanted at least a chance to get them to think about what they were doing, and we talked about the pros and cons of the idea. And so that, that was, I guess, a bit of a confronting conversation. And we're effectively saying to the client that, have you really thought this through? And they hadn't, as most clients don't. These tend to be emotional purchases, which is very frustrating when someone comes in to get advice from you and yet they've already made some really key decisions right before they come and talk to you. But having those conversations that clients don't want to hear is actually really core and valuable part of being an advisor, I think. So.
So would you say the majority of clients come through, there is you would make a call to them saying this party situation is in not good shape, this. Is that how you go about it?
Not always. No, not always. We always do with the cash flow side of things. I mean, if you think about...
So cash flow, you beat him over the head?
Cash flow, we do, yeah, we do.
Or smack them on the wrist.
It's a behavioural problem, and it's, of all the things that are likely to be stopping any client from progressing financially, that's the one. It's not because they've got the wrong super fund, and it's not because they've bought the wrong property or they've got the wrong share portfolio. It's far more likely that they've got a cash flow and spending problem. And so that is one that you kind of need to up front get out there and say, we really think this needs to be done a hell of a lot better. And it does resonate well with a lot of clients.
Well, if nothing gets done around that space, your toolkit for what you can do to their situation is very limited.
Correct. And one of the things that we debrief after our initial meeting with a client is, well, these clients actually take advice, because we don't want to engage with someone, spend hours and hours and hours constructing all the advice for them, and then have them go, no, I don't want to do any of that. So it's really critical, I think, to have a think about, and you get a pretty good feel through the meeting. Will these clients actually listen and look to engage with the advice you give? Do they actually want advice? Because strangely enough, some clients actually don't want advice, even though they come in to see you.
They like the idea initially.
Yeah.
But when they find out what it is, I've got to change my situation. No,
I don't want to do any of that. No, I just got to leave it all as is.
No, you were meant to just make everything grow bigger.
That's
and I was just going to continue living how I've been doing things.
Yeah, absolutely. Yeah. So that cash flow discussion, is about being pretty upfront about it. Almost no one runs a cash flow budget you would say is in any way accurate. You get that occasional engineer personality that comes in with a spreadsheet that's so complicated you can't even read it. But in general, most people either don't have one at all, or it's something scribbled down on a bit of paper with about 9 different expense categories, and you go, hang on, what about gifts and haircuts and doctors and physio? None of this stuff's on this budget, and you're telling me you spend $35,000 a year with a family of 4. Oh, it's interesting. That's not right.
Statistically, that doesn't match up.
But you think about listed companies on the stock market. How many of them don't have a budget? I'd probably guess 0. And then you flip it over to our personal circumstances, and it's almost the exact opposite. Almost 0 of us have. In today's age, there's technology. So there's not really the excuse now that we probably had maybe 10 or 15 years ago, where you had
any gaps in access to information.
Yeah, that's right.
It's easily there.
Because no one's going to spend 3 hours a week keeping a cash flow budget. That's for sure. I wouldn't do that.
Well, unless those engineer clients.
Except those occasionally
don't like watching clients. TV. Spreadsheet gets them
that's
off.
That's right. They love it.
So I guess it sent you on this. It sent you on this journey. You've acknowledged cash flow is significant, and I guess there's a great segue into where you started to explore and come up against walls in that space, and where it got to another thing that you're doing, which is an app for cash flow.
Yeah, that's right. So as I said before, we spent a lot of time kind of looking at what's not working in the business and how do we fix it. And we kind of ended up getting to cash flow, and it wasn't working at all. And in fact, the process that we were using was almost driving a wedge between us and the clients. And if anyone's done cash flow budgeting work with clients, they probably know the problem of trying to get clients to keep the technology up to date, reconciling transactions. And it's something that can become a problem if you're saying to a client, you've got 900 transactions we need you to reconcile again in preparation for our next chat. Because, of course, if you don't have the numbers, there's a problem with your delivery of service. And clients might do it the first time, they might do it the second time, but after maybe 18 months, it just falls over. They don't want to do it anymore. So we said, okay, our technology solution isn't working. We need a better one. But we just want a cash flow solution. So we went out and kind of had a look at all the options, and we talked to lots of advisors about what they were doing and what they felt was working really well with their cash flow work. And we couldn't find anything that sort of did what we wanted it to do. Not that it was that complicated, we just wanted something that was really easy for the client to use, didn't require hours and hours of our time to get some useful data out of, and would give us the information we wanted about the clients so that we could have better conversations really with the clients. Because ultimately, we're trying to change behaviours, and that's not very easy. It's like, imagine if your business was trying to stop people smoking or stop people gambling. If they have that problem, it's incredibly difficult to get them to change. So if you're going to try and change someone's cash flow behaviours, you need the information at hand. If that takes you hours and hours for every client to put together, it's a problem, because we're trying to be profitable businesses, and then the cost of delivering that service goes up, and so it becomes a question of, can you deliver this in a valuable way to the client? So in the end, we bit the bullet and started work on our own technology app, and that has been a challenging journey, and it takes some time, but we're finally kind of there, and rolling that out to our clients now, and it's doing the things that we wanted it to do, particularly around being very, very simple to use, from the perspective that as the advisor, we really don't have to set anything up. Not even the budgets if we don't want to. The system will do the budgeting for us. We've got a portal where we can see all our clients. We can see which ones we should be talking to because there's some issues around meeting budget.
Yep.
And all the time we spend on cash flow work now can be the actual conversation with the client or something valuable for the client, rather than banging away doing some form of administrative
Doing the work,
or getting the admin staff to be chasing up clients, about reconciling and
what was that item?
Correct. So
you're essentially, you've got an output or a dashboard that tells you everything that's at risk or any clients that are.
Yeah.
You've created, you've worked out, you've gone, okay, well, with your experience, you've gone, okay, when that happens, that's an issue. When that happens, that's an issue.
Yes. So if you think about budgeting in its simplest form, it's just simply knowing how much you spend. But you almost know that by default by how much someone's saving. So how much you spend is not very useful. And even, telling a client how much they spend and where that money goes is also not that helpful, because the first question we get asked by a lot of clients is, okay, so what does that mean? And you're like, well, it just means you spend that much money in all these different categories. And they're like, okay. And it's like, okay.
Yeah, I really enjoyed that category.
Yeah, that was good. Yeah, that's great. And so, one of the things that we found more helpful is to be able to say to them, well, you're spending 50% more on eating out than you do on groceries. And when we look at the rest of our clients, you're spending double what on average they're spending. And clients kind of look at you and go, oh, right, I didn't get it, but I get it. Right, we've got a problem. And you go, yes, we have a problem. We've got a benchmark. Yeah. And we wanted to filter that so that we could, if they're a family of 4, well, let's compare you to other families of 4 that we work with, or single.
Is it just, are you looking internally in your business for that benchmark?
Yeah, so it's in the app data for the client group. So for our business, we can see our clients, and we can still filter that because we work a lot with clients in Queensland and New South Wales and some rural areas. So we can still filter that out as well if we want to look at our clients in Queensland or whatever it may be. But yeah, we would really wanted to give them, because it's more powerful to tell a client how they compare to someone else. Than just to simply tell them the numbers. And we've been doing cash flow work for probably about 6 or 7 years now. So it was one of the things we added, in those first couple of years of converting our business into this engagement model. So it was one of those areas we highlighted as we really need to start doing this and doing it really well. And so, it was one of the kind of journeys that we went through, and the learning outcomes that we got was you need a bit more than just simply telling them where the money goes, because you can't get them to change their spending by doing that. And so some clients you need to contact all the time, and some clients you don't need to contact much at all because maybe they're very good with their cash flow, and maybe what they're spending is perfectly okay, and maybe you actually want them to spend that much money because some retirees, they want confirmation that this is okay.
Well, I was going to talk about that and the demographics difference. My experience was that you'd sort of end up with people that were really good savers in retirement and all through their life, and they're set up for a nice retirement, but that behaviour that's been in place for so long, it's like, spend that money. We'd have the conversation. Get the new bathroom. It's okay.
That's right. Yeah, absolutely. We've got a few clients like that we kind of have to encourage that, this is okay for you to spend this money. And how about that holiday we've been talking about for 3 years? We think you should do it. Let's actually do some planning around booking it in.
So maybe some positive notifications going, has not spent enough.
Yes, that's right. You're not spending enough on travel. Absolutely. So we're working with a retired client. The value in this cash flow work with them is less, but there's still a role for it. It's a lot more valuable for some other demographics, absolutely, particularly those clients that have a real spending problem.
Well, I love stuff that's developed from the ground up with a core problem that's been identified at the ground floor, face-to-face with the client. Yeah. Just working back from the client instead of, coming in at a higher level with a concept that's maybe sometimes disconnected from what's going on the ground. So what's it called, Scott?
Savvy. So the web portal is Savvy app. And so we've got a few parts. We've got the mobile app that the clients can download, and anyone can download that for free. It's on the app stores and the Google Play Store, and so that's free. If you want to get that client's data or that user's data, we'll generate an advisor code, and they simply put that into the app, and that will feed across into the web portal that you log into with all of your clients listed there. So you've got a dedicated
simple pull through.
Yeah, so there's no setup. There's no client setup.
Okay.
You don't do anything. You just get them to put that code in.
Yeah.
And, some clients are pretty bad at following instructions. So worst case scenario, you might do it whilst they're in the office with your next meeting. Yeah.
So they don't have to log into each of the accounts?
They do have to log into the bank still. Okay. But that's a the reason I made the final decision to go ahead and develop this technology was that open banking was coming. So until open banking is fully rolled out, you will always have to log into your institution through a data aggregator. So the app uses a data aggregator to get that information. So the app itself doesn't integrate with the bank. The data aggregator is doing that, and they've already got those API feeds there. We're just getting that information then from the data aggregator. So the app itself doesn't log into your bank or anything like that. But once open banking rolls out, the difference will be no more logging in to set it up to the bank. And the data will feed live, so
start to be a lot better quality.
Yeah, that's right. So the client, will see it in the cashflow app seconds after they actually spend the money. So that'll be very exciting for that part of the industry. Absolutely, yeah.
So if an advisor's curious about what you're doing, obviously a cashflow app developed by an advisor for their clients that is available for other advisors.
Yes, yeah, absolutely.
So they go to savvy.com.
Yeah,
.io.
Savvyapp.com.au. Yeah, so that's right. So it's we've got a website set up for the app. It's very simple to use. So what I'd probably suggest doing is actually download the app itself and have a look at what your client's going to see. We wanted to keep that.
So you can trial it without.
Yeah, that's right. So you could just download the app yourself. We've got no contracts or anything for the advisors. So if they want to join up and throw their own data into the feed before they bring any client work in, they can do that and see how it works from both sides. Okay. And then if they've used it for a month, they go, no, we don't like that. That's fine. They just shut it back down. Worst case, they get charged $10 for a month, and off they go, learning journey, I guess. But we developed that app for the client to only show them specific data and the information that they kind of want to see. So one of the key things we want all of our clients to see is, what's my non-discretionary spending? What's the stuff that I don't really want to spend but I kind of have to, petrol and insurance, etc. And what's my discretionary spending? How much am I spending on the fun things in life? Because that's a really important split between those categories. Totally. We don't have spending problems in those non-discretionary areas. People don't spend more on groceries than they want to. So it's all the discretionary stuff. That's the area that you'll have.
That's where you can reduce. That's where you got the...
Correct, yeah, that's right. If you've got a spending problem, it's going to be more likely on clothes, travel, eating out, entertainment.
Alcohol.
Yeah, alcohol.
Oh, wait, actually, how do you categorize? Because entertainment as a categorization, for someone that drinks a lot of, you're having a great entertaining time. Does alcohol go into entertainment, or do we identify alcoholics?
Alcohol's separate. Alcohol's separate out of the entertainment category.
Has it been quite interesting once you've had that rise to the surface for some clients?
Yeah, I mean, it's all some clients like life's too short kind of attitude to the cost of a bottle of wine, and others are very different. But we haven't had too many.
Just trying to remember some of the bar names in Canberra.
Yeah, that's right.
Mounties. What was the one?
What would you be thinking of? So that's how often I go into bars these days.
Yeah, the closest thing is seeing them come up on your clients'
that's
transactions.
Right. That's right. Yeah, well, we've got a few clients where it's, KFC, McDonald's, 5 times a day.
Do you have a nutritional discussion with them after that?
Well, it's funny, isn't it? Financial planning almost has to form, or look at almost the kind of psychology aspect of even things like relationships and things like healthy eating and how do we overcome, even for insurance, obesity issues, etc. So there's a lot of stuff like that
So much
it's not
potential.
something it's not something we've delved into, but they are things we've thought about and how could we deliver some services around that, perhaps not even internally, but how could we bring in some external help
Totally.
with that?
Yeah, and that's the key. You don't always have to do everything yourself.
Absolutely, but if you can deliver the solution through
The
an external
identification
provider,
and bring it in.
you want those clients coming to you with any problem, even though you go, well, geez, I don't know about who's a good dietitian, but I'm glad you asked me. That's what you want to have happen.
Totally.
Yeah.
Well, Scott, thank you for coming on.
Yeah,
It's been
no
a great
worries.
chat.
Yeah.
We've gone through a few things and really exciting what you're doing with Savvy. And,
absolutely.
any advisors, please reach out to Scott. He's a great dude. He'll chat to you about it. And
Awesome.
And it sounds like it's doing really well. So thank you very much.
Yeah, thanks, Adrian. Thanks for your support.